All right, welcome back to another episode of the Deduction Desk. Getting closer to tax season, getting closer to end of the year in 2025. So we figured one of the things that we'll start recording on is understanding the new changes for 2026, right? If you're starting off planning for taxes the year before, you're gonna be in a much better shape. If you start planning for taxes in 2025 now, you're behind the eight ball.
You're done
already, right? So how do we put ourselves in a position to properly plan? We start planning now for what could happen in the future for 2026. That involves some of the tax changes, things like taxes on tips, tax on overtime. We're going to talk about phase out limits on SALT cap expansion, on a few other topics. But this video is where you start the planning for your tax season for 2026.
Yeah, there's a lot of changes, a lot of things that were temporary or things that people were waiting on became permanent and enacted in full now. So there's a lot of changes that have happened. For us to go back to the pre-Trump tax cut era is almost impossible.
Right.
Other than the things that are going to phase out, like accelerated depreciation, things that are written in to phase out.
To phase out, correct.
New, certain things have already been permanently increased, right? The AMT numbers have been permanently increased. The standard deduction numbers have been permanently increased. The SALT cap is permanently in place. So we'll go through each of these little things, which we don't want this to be like that first video we made, which you should go and watch, which is a little more detailed. This is more going to be like the high level hits, try to be quick, try to be informative, and help you understand what's changing, because that's the first step to making a plan for how to optimize.
100%. And I think, obviously some of the things that Sagar just mentioned for permanent tax rates that changed, what does that help with from a planning perspective, right? Well, number one, Roth conversion planning. How much should I be converting to Roth to make sure that moving forward, I can, earn all of that money on a tax-free basis? Multi-year income projections, making sure that we have an idea of what we earn this year, and then what are we going to earn for the next couple of years, so that whether it's Roth conversion planning or whether it's retirement planning that we can put in place, or whether it's tax planning that maybe we depreciate more this year compared to next year. So all those things are important to keep in mind before you start the planning process of what you're going to potentially do.
Yeah, and if you're worried about 2025, here's some good news, right? Like for most of the people that we're doing our 25 projections with, if you make less than $500,000 a year and you live in a state with high income taxes, you are saving money on your taxes. The closer you are to that $500,000 limit, the bigger your savings are, obviously, because your bracket is higher. But we're definitely seeing people with lower tax bills. Now, if you're making over that $500,000 number, maybe not. But that's a different conversation. So without having to do anything, just the way the SALT cap is working, which is, for those of you who don't know, the SALT is the state and local taxes. That's what the acronym stands for. It used to be, prior to Trump tax laws, you used to be able to deduct all of your state income taxes. So if you lived in a state like New York and you made $1 million a year and you paid like the $80,000 a year in state income taxes and city taxes, you'd be, well, more than that, it'd be like $110,000 with the city. Let's just say you're paying $100,000, whatever. You would be able to deduct that $100,000 of state income taxes against your federal income taxes, or your federal adjusted gross income. So you'd save about $30K in taxes federally by paying that $100,000 in New York. That went away. In 2018, it capped it at $10,000. So basically all your state income taxes were no longer counted as a deduction. A lot of people consider that a double tax. They've increased it a little bit. Now the cap has gone from $10,000 to $40,000. And you see how powerful and important it is to have no SALT. I'm a big believer in not being a SALT tax. Like, I think it's straight up double taxes. But just that change from $10,000 to $40,000, we're seeing people save about $10,000 to $12,000 a year in taxes. So, keep pushing. If you can, write your senators and try to get rid of the SALT cap altogether. But, I think with some of the other things that are in there, there may be ways to offset some of that SALT, even if you're over that $500,000.
Meaning increasing the SALT from 40 to unlimited, right? Whatever you're paying in state and local tax, you shouldn't be paying in federal tax.
It should count as a deduction, right?
Right.
Theoretically, your state would be taking less federal funds, and you're paying into the Fed, but you're probably taking less. So
so they're using the same number for both tax positions, when they should at least reduce the state, and then you pay the remainder of what you didn't pay in state and federal.
That's what I think.
It makes sense. But you're right. And the phase out for that is $500,000 for a single, $1 million for joint. So, again, relatively high, but for some of those individuals that are getting close to that $500,000 mark or $1 million mark if you're joint, that's where the planning is important to come into play, right? You may look 2 years from now and say, hey, based on my business, based on, my dividends from certain investing, based on income that I have from rental properties, I'm going to be over $1 million. million, it's important to start that planning early so you don't run into the conversation with Sagar that says, oh, this $40,000 cap is actually zero now because you're making over $1 million between you and your spouse. So that's important to take a look at.
Yeah. So, and some other good stuff, right? We have the AMT cap got increased to like 1.2 million for married filing joint people. Yeah. That's great. If you're a high earner, you're avoiding that AMT for a longer period of time. Standard deduction increased at the behest of a reduction in itemized deductions, but you still got that increase there. Senior deduction is permanently in place as long as you make less than $150,000 a year. That's in place. SALT cap we discussed already. That increased from 10 to 40,000 as long as you make less than $500,000 a year. Car loan interest now becomes deductible in certain situations. That's the key word there. Certain situations. Okay, the car has to be assembled in the U.S.
Can it be a foreign car but not assembled? Assembled in the U.S.?
Yes.
Okay.
Right. So like Toyotas, there's some Toyotas that qualify. There's websites.
Kia has a factory here now, or Hyundai has a factory here now. Right?
Correct.
So if it's assembled here, that's where those deductions
Correct. Car has to be less than 14,000 pounds. So it can't be like a commercial vehicle, basically. Right. And you're using it for personal use only. Can't be writing it off from your business and take the loan interest deduction. Not allowed. But loan interest is always deductible if you put it through your business. So opt for your business anyway if you can. Then casualty losses go back into play, right? So these are now federal. If you have like a federally declared disaster that occurs, that personal loss, like let's say there's a hurricane and it's a FEMA disaster, you get to deduct the loss
the entire
that you're
loss.
Able to take. Excess business losses is a big one. This is like what tripped up a lot of the goofballs who are pushing the itemized deduction Airbnb stuff.
Yeah.
Right? You can't take more than a certain amount of losses against income.
Okay.
So, having an entity that just runs like $1 million loss, that's going to end up causing you to pay more in taxes because you won't be able to use those losses. Moving expenses, gone. Can't write them off anymore. That's not a good thing, but it used to be, something that people used to be able to do. Now it only applies to businesses and people who have home offices, things like that. But you actually moving, can't deduct it anymore.
Well, again, and that kind of leads to the conversation we had with a lot of these taxes when they came out, right?
Yeah.
Is that if you own a business, a lot of these taxes are benefiting you compared to, an individual who maybe works for a business, right?
Yeah, exactly. So, keeping the same theme of things that have kind of not good, right? We had the excess business loss we quickly talked about, which, there's other videos on that. The moving expenses are gone. Right? And then stuff that sounded pretty good, but didn't end up shaking out as great as people thought.
Yeah.
One of them is the tax on tips.
Yeah.
Okay. Tax on tips is, very limited to how much businesses can actually qualify for it. There's supposed to be a list. Last I checked, it hasn't been released yet, but there's supposed to be a list of businesses that are commonly subject to tips. Okay. We don't know who's going to make that list, but we know who's not going to be on that list. And that's anybody who doesn't qualify for QBI. So if you don't take QBI right now and you have a small business, think about it as, like accounting firms, doctors, lawyers, people who are selling services generally are not able to take QBI, which is qualified business income deduction. They also would not be considered entities that are able to take the tips. Okay.
You telling me my heart surgeon can't flip the screen around and say how much you want to tip me for saving your life?
Yeah, exactly.
Yeah, because I feel like all of us are anticipating that.
Joe's like, no,
zero.
Yeah. No, so that for sure. But I was even saying, it's like, okay, why can't I just start tipping my employees, right? Or be like, hey.
If you're the business owner, why can't you tip the employees that are working for you?
Yeah, or your tax bill, I just tack on a 20% tip and use that to pay the staff. Could I have done that?
Well, doesn't seem like that's what the government doesn't want people to do.
Yeah,
right?
they've already said you can't do it. So.
Right, because they knew we would get smart and say, well, I'm just going to tip my employees.
Well, there still may be a way to get smart, but at least we know.
We're not there yet.
We're not there
we're working
because they haven't released any of the info, but certain things are definitely going to qualify. Restaurants.
Yeah, of course. That's like the number one you would think of.
Uber drivers. Yeah. Baristas. Right. So those places are, those people are definitely going to qualify. I don't know where else it may be. Yeah. Could landscaping count? Right?
Yeah. Or car wash. You usually tip them.
I tip my doorman. I tip my post office people.
Yeah.
So does that count? Is that income going to be non-taxable? Now, here's the key. If you want to take the tax on tips, it has to run through your W-2.
Right.
Which, let's be honest here, how many waiters and waitresses are taking those cash tips and running them through their W-2?
Zero. 0%.
Right? So that's the first part of it. The second part of it is you still pay FICA taxes, which are your Social Security, Medicare taxes. You don't pay income tax. Okay. And you also don't pay income tax only if you're below 150,000 joint, single, or 300 joint. Okay. So that's, I don't maybe
Wouldn't that be the waiters?
Maybe I'm being biased. Maybe I'm saying, okay, waiters are making 300,000, but like, I guess it's married filing joint, so it could make a difference. Like maybe you have somebody who's in a smaller business or a startup business, or
so here, here's another thing that most people don't think about, and if we're talking about waiters and waitresses from that capacity, you're in a position now where you don't have to pay any income taxes on tips. You're still going to pay Social Security and let's
Medicare,
say Medicare, but if your tips are significant and you don't have to pay income tax on them, but it's going to help increase your Social Security down the road, you should be putting them in,
and it's the legal way to do it.
Right.
Well, it's not.
Well, yeah, obviously, we want to do everything legally, right? We're not promoting non-legal things.
Yeah.
But
no.
I'm just kidding. But things like that are important because you don't realize, all right, I get to the end of my career as a waiter or waitress, and let's say my whole career that's what I was doing, and my Social Security payment is $1,000 a month.
Oh, what if you break your leg and you got to go on disability?
Right.
Or
that's a whole other video.
Or
right.
Or something happens and you are incapacitated.
Yeah.
You start collecting Social Security early.
Yeah.
You haven't been paying in. You get laid off.
Yeah.
Your restaurant shuts down.
Yeah.
You should be on payroll. Now you can't collect unemployment because you're off the books.
Exactly.
So lots of important reasons why you should always be pushing. The only, I say always push to be on payroll. It just helps your employer deduct the cost of you, and it helps you qualify for all these benefits that are out there. And then, as with no tax on tips, the other big talking point, no tax on overtime, right? So there's a higher threshold for the no tax on overtime, $500,000 if you're married, which is nice. You still pay Social Security taxes. Here's the caveat. Let's say you qualify for this overtime rule, right? We've had a lot of cops that have asked about this. Right?
Nonstop.
So in this case, let's say you're making $20 an hour, right? Your overtime would be $30 because you get time and a half.
Right.
Okay. Out of that $30 of overtime, you still pay tax on the $20. The $10 additional, you avoid income taxes on.
Still pay Social Security, Medicare.
Still pay Social Security, still pay Medicare,
FICA.
Still pay state income taxes, still pay state withholdings on family leave and things like that. Right. But you do avoid the income tax on the additional and a half portion of the time and a half.
So if you're originally making 20 and this overtime paid you 30, 20 of that 30 doesn't count.
Correct.
But you're going to get time and a half of that extra.
Correct.
So that'd be 15.
And a maximum deduction of $12,000.
Okay.
So anything above that you don't get.
Right. So if it's $10, you'd be looking at $15 as that amount, and then up to that $12,000 cap.
Yeah, maybe some people save a couple bucks.
Yeah.
I don't think whatever helps, right?
Right.
So that's how the tax on tips and tax on overtime works. We've had asked a million times about it. We'll probably do another longer video just to explain. Probably wait till some of this guidance comes out, but that's something you should be thinking about for 2026.
Yeah, it's nothing that's like going to put a pool in your backyard, but it will save you some money.
Yeah, maybe. Well, we just did the math on it, right? If you make $500,000, you can deduct up to $12,000.
Right.
So you should be, and your tax bracket's probably going to be effectively 24%. So you'll save yourself about $3,000.
Right. Okay. So a couple of chairs in the pool.
Yeah. But Joe's got a nice pool, I guess. He's looking
I don't have a pool, but the people have been asking me about this. Want to put a pool in.
All right, same thing. Child tax credit increased permanently. Great, awesome. Adoption credits. Those have also become permanent now. You get up to $5,000 for adopting a kid. Clean energy credits are gone, out the window. This is the last year. You have by the time you guys are watching this, the year's probably already ended. So
it's out.
It's done. Don't even
talk about
worry about it. Yeah.
You can adopt a kid though if you have a little window if you want to save some money.
For sure. You can go adopt the kid.
It's probably crazier shit that goes on. People are like, wait a minute, $5,000 per kid?
Yeah, let's get 50 kids.
Yeah. We'll get 10 kids a year. We don't have to work. That's probably happening in some neighborhoods. Go ahead.
So then business-wise, things that are generally, I think, better in terms of long-term for tax savings. Bonus depreciation is permanent, which is fantastic, right?
Yeah.
Section 179, which is what everybody calls accelerated depreciation, that's going to be in place till, with a higher cap until 2032 on many types of assets. Also still in place for things that are commonly accelerated depreciated, but the things you're probably thinking about, which is the properties,
your car.
the car.
Right.
Yeah, I mean that should stay around for the next 6 or 7 years. R&D, this is a big one for people who are tech firms. We did an R&D video earlier too on how to take the credit, the R&D tax credit. This is a different side of that. This has to do with what you can deduct for R&D. Let's say, me and Joe decide we're going to develop a new tax platform. Whatever we spend on it, theoretically, if we're not making money on it right away, we have to capitalize it and then amortize those costs in the future. So we can't take the deduction right now. If I make $1 million and I invest 100,000 into this tax platform, until it starts generating revenue, I wouldn't have been able to take that $100,000 as a deduction in the past. That's gone now. Now I can immediately deduct those expenses because of the future revenue that's going to come in. So it's nice for people who want to innovate and spend money and invest into their business. This is a great opportunity.
In America, right? That's the incentive.
In America.
Is that we're trying to build things that we normally wouldn't have spent money on, but now we're getting incentivized to spend money on research. So
for real. And I think that's like one of the bigger changes that I think makes a lot of difference for a lot of businesses. If year end is coming around and you're like, hey, there's maybe a piece of equipment I want to buy, some software I want to buy, a company I want to engage to do their research and development. It's a great option to save some money on taxes. And then the only other things that you should be aware of is we've been hearing about the $600 1099 thing for damn near 10 years now, where they're like, hey,
you're talking about Venmo?
Yeah. If you get more than $600 in Venmo over a year, they're going to report you.
Right.
Never has been implemented because of the fact that all these companies are complaining, saying, do you know how hard it would be to track
that?
Every single
all the fantasy football managers?
Or the people
you're in
like
trouble.
husband and wife, that split
just
their
spend money
bills.
back and forth.
Yeah. How are you going to track all that? How are you going to see what's real, what's not? Are you just going to cause a bunch of reporting requirements for people that have to file more forms for no reason?
Yeah.
Well, they said they're going to increase the threshold for 2025 to $2,500. Okay. So if you receive,
it's a big fantasy league.
Big fantasy
should be under that, right? You would think.
Yeah, anyway. You should, right? Well, I haven't in years, so.
Unless if you win, but if you're the one collecting it all, right now you're showing income that you don't need to show.
That's true. Right? If you're the league commissioner,
just don't be the commissioner. Next year, if you're watching this video, you're way ahead of it. Just pass it off to somebody else.
Exactly. And you will have to file, in your tax return, what the purpose of those receipts were.
Right. Which is gambling, which now I don't know what the repercussion for that
I don't know. But you're going to have to say what you were doing with this money that was coming into your account. So that's going to go back to $600 in 2026. For 2025, they've increased the limit. So if you're below that threshold, you probably won't get anything. But keep that in mind. This is continuously, we've seen different administrations push for this, then say that they're not going to implement it, only for them to say it will be implemented the following year. And it looks like that's happening again for this year. Let's see what happens by 2026. But be on the lookout. Be aware that you may be getting 1099s for just transferring money back and forth with your friends. Going to a dinner. And, paying for the dinner yourself and everybody Venmos you $200 each.
Right.
That might be a tax. That might be not a taxable event, but
it's
a tax
reporting
reporting
event. Right.
Yeah.
Well, listen, so, short the private fantasy football leagues and you invest in the companies that
Daily
are now going to let you do it on there. Right? Because there's some platforms you can invest, you can put all the money on the platform, then you don't have to take it.
True.
Right?
True. Cheddar up.
Stock tip.
All right.
I don't know the companies, but check them out. All right, thanks guys. Happy planning for 2026.
Good luck.
We're also going to put something on the website that gives you a little bit more detail on all these topics. So if you have questions, you can book appointments on there. And then we look forward to a great year in 2026 with this tax planning.
Definitely.
Thanks guys.
Bye.
See ya.